Welcome everyone to another weekly meetup at Story Trading. We have a special guest tonight, Richard Chu, so we're excited to hear from him. Before we do that, I'm going to go through a quick disclaimer. Story Trading is not an investment advisor, and neither are our guests unless they specifically say so otherwise. Investing in securities involves significant risk of loss. This presentation is being recorded. It's going to be available to our VIP members throughout the week, and then we're going to be publishing it on YouTube next Sunday evening. So those of you who are new, what we do at Story Trading, we're an investor community, and we're aiming to beat Wall Street insiders at their own game through crowdsourced collaboration in an effort to understand the story behind the trade. And we also have exclusive access to VIP presentations, as you're seeing here, for 7 days for an extra edge. We're building our own app in development, which will make all of this even easier. So stay tuned to learn how to be first in line to that invite list. As far as tonight's agenda, we will do, we'll get our VIP presentation tonight. We'll start with a performance review first of our previous picks. Then Richard Chu will come in. He's going to do a quick overview on digital health, an area he's very well known for. He's also into other stocks, not just digital health. So I'll have a VIP pick for you tonight outside the digital health sector. And we'll do a Q&A, go over our upcoming events, and then we'll turn off the recording to do our trade of the week. Okay, so with that, before the first thing I want to point out again, that was, well, let me just show it here. So that's our website. If you click on performance right there, it'll take you to our live spreadsheet where you can see all of our VIP picks from guest presenters and VIP members of our community. And you can click on the return by presenter tab to see how people are doing individually. So we're looking forward to adding Richard Chu's pick over here this evening. And with that, Richard is here. I found Richard because of our common interest in Dario Health. He's a very smart guy. I recommend you follow him on Twitter. Looking forward to tonight's conversation. So Richard, with that, I think you have co-host rights. You can unmute yourself and give yourself a quick little intro, and we'll take it from there.
Great, thanks, Ben. So I'm currently an analyst with Saga Partners. We're an RIA based out of Ohio, and you can find me on Twitter. My handles should be down there, I think, as well. So the main areas I concentrate in are in SaaS as well as in digital health. And tonight I'll just be giving an overview of my views on the digital health sector, as well as one pick that I found recently. It's a SPAC. And it's actually not in digital health. It's in another exciting space, connected cars. And I think that it's potential for great growth and going forward. So I don't know if I can. Okay, so Ben, you will click the slides for me.
Sure. Yeah. Let me know when you want to go forward.
Okay, so yeah, just to start, I think healthcare is one of the last multi-trillion-dollar markets out there to be disrupted, and it's been notoriously hard in the past because of misaligned incentives, lots of red tape, and a general lack of impetus from the system's main stakeholders. So I think today the United States spends more on healthcare than any other country in the world, but it isn't seeing comparable outcomes. So yeah, and it wasn't until very recently that COVID really shone a spotlight on the sector. And as you can see from the chart there, in 2020 alone, the digital health sector really sort of blew up in terms of venture funding, $12 billion it's estimated to be. And that's been sort of a big increase from previous years, really due to the fact that, there's a lot of regulatory barriers that came down. There's been, providers being forced to adopt telemedicine and other innovations in order to keep their patients. And generally, there's been sort of more employer interest as well as payer interest in the sector as well. And a lot of companies have IPO'd, of the recent ones own Livongo, GoodRx. You can talk about Peloton, Dario, of course. So really, I think digital health, the whole revolution wasn't possible until very recently. And that was mainly because we didn't really have sort of the necessary tailwinds to to in terms of technology. So you can think about Livongo's solution. Like what does it like? You can think about Dario solution. It's the same thing in terms of using sort of like connected devices, health coaches, um, like being able to actually analyze that data within the cloud, collect it, and then implement machine learning to be able to extract insights and provide health nudges to patients. So it was only through the sort of confluence of all of these prior mega trends that companies like Livongo or companies like Dario are now possible. And that's really sort of changing the way that we're delivering care in this country and really bring better outcomes for lower costs that wasn't possible before.
Great, thank you, Richard. Before you move on to your pick for tonight in the connected car space, I just wanted to ask you a couple questions. We're going to have a Q&A from the floor later after your full presentation, but regarding digital health, I was wondering if you could first just give us a comment on the market action in the last couple of weeks. And Teladoc, the bellwether there, I think has brought valuations down for the entire digital health sector. So just wanted your view on where we are now in terms of that correction and the valuation of Teladoc, which is, again, impacting all the other stocks.
Yeah, so I think the valuation for Teladoc is quite attractive now. It's come down definitely like around 40% over the last just 2 weeks alone. I think it's only trading at like 14, 15 times this year's sales. So that's sort of quite low if you just compare it to SaaS. And I think generally valuations for digital health compared to SaaS have been quite attractive as of late. We at our fund have repositioned from some SaaS names into digital health names like GoodRx and Teladoc. And that's mainly because of the fact that, like I don't think that the SaaS comparison is entirely is not entirely unwarranted because like Teladoc, they have around like over 80% recurring revenue now. GoodRx, 80% of its transactions are repeat transactions. So there's very good recurring revenue for both of those companies. There's huge TAMs to be that they're barely penetrated within. They have high gross margins. They have very lean sort of operating models.
Okay, great, appreciate that. Just a couple quick additional questions. OnTrack has gotten clobbered for a company-specific issue there. They lost a huge customer. I was wondering if you have any thoughts on that. Is that a red flag and stay completely away, or is there a evaluation here you'd be interested in this stuff?
Probably not in terms of OnTrack. I think they definitely had some pretty big issues with the loss of Aetna. That definitely doesn't inspire confidence, not just from investors, but like from like a potential customer standpoint. Like I would want to first understand the reason behind why they lost that customer, and like if sort of their like platform is fully intact. So I didn't own a position in OnTrack before and don't plan to initiate one.
Awesome, I really appreciate that. And then we got earnings for Dario this week. I don't know if it's tomorrow or Tuesday, but I follow you on Twitter. By the way, anyone who doesn't follow Richard will share his handle later if you want to share it now. But I think you gave some comments on what you're looking for out of Dario earnings. A lot of people in our community have large positions in this stock, so we're definitely interested on your thoughts on Dario.
Yeah, so like I definitely really like Dario. Like I think they're a major player in the digital therapeutic space. They're sort of the only company really that I found certainly that's been public now with Livongo taken out. And it's really like a huge sector and it's really barely penetrated. Like I think they recently mentioned, like with MSK alone, which they acquired Upright for, they're like the penetration rate they expect to go from like less than 1% to over 20% within the next couple of years. So that's really going to be a huge boost for everyone in the sector. In terms of valuation, like I think right now they're trading at like 14 times this year's sales. So definitely isn't as cheap as before. So in terms of their guidance, like I really want to see them at least guide for 40% growth for 2021. I think they haven't indicated where Upright will come in at, but their core business alone should be growing at like over 50% this year with like all the new contracts launching and sort of the gross margin inflection that they're getting from the transition to B2B.
That's all right. Good. That's great. Very helpful. So I'm sure maybe some other people have additional digital health questions for you at the end, but for now, let's move on with your presentation for tonight. We got Software Acquisition Group, ticker symbol SAII, last trade $10.32. You got a chart. We got a chart there to look at, and there you go.
Yeah. So I'd say, like, just to start off with summarizing the problem, and I'll use this sort of this paragraph from Bessemer Ventures. Bessemer is a very well-known VC firm. They've invested in Twilio, Pinterest, and now they're also an investor in Bessemer as well. They've been in all their rounds, which is very rare for a SPAC like this. And really the problem that Otonomo is trying to solve is just the fact that, like, despite the rapid rise of connected cars and OEMs wanting to provide new value-add services, it's still very, very hard to be able to build that kind of service. And really, I think the bottleneck here is the fact that they need data. And in order to get that data, they need to partner up with each OEM very separately. And then that data then needs to be normalized from, like, the fact that each OEM, each car model, they all have different data. So it needs to be standardized across all of that. And then, like, you have additional things to worry about, like privacy, other like billing policies, whatever. So Bessemer describes building a connected car service as much more difficult than it was before, like the smartphone days. So I think, like, the solution to this would either be, like a common car operating system, like one that all the OEMs can work with, which I think is unlikely. And I'll talk about that at the end. But the other alternative is to create a third-party marketplace. And that is the one that, like that's what Otonomo is trying to build, one that takes the data from all the OEMs, standardizes it, and then resells it to an ecosystem of app developers. So just to describe Otonomo, it's a vehicle data platform. It's similar to Twilio, communication platform as a service, but for connected cars. So they have patent pending technology, and they currently work with over 16 OEM partners, including Ford, GM, and BMW, who are able to provide data on 40 million connected cars and then make it usable by customers, by developers via API. So they're currently based in Israel, and they project revenue to grow from 3 million in 2021 to 574 million by 2025. So I get that that would make them, one of the fastest scaling companies ever. But as with all SPACs, like, the revenue projections are very, very aggressive. But I think right now they're only trading at a $1.4 billion valuation. So about like 2 times something their 2025 sales. So it's definitely not that crazy, even if they don't even if they do like half of what they're projecting for 2025. So why is a third-party marketplace needed? So like, the main benefit of Otonomo is their neutrality. And you can look at other aggregators like Roku, like the Trade Desk. Like with Roku, the benefit is that they don't create their own content. So within the beginning, they were able to, partner up with all of the different content providers who may have taken issue with the fact that Amazon, for instance, has its own content. And the same thing here is, like, Otonomo, they can work with all the OEMs, because the OEMs, they don't want to work with each other. Like, you're not going to see GM share their data with Ford or anything. So what data is collected here? You can see that they capture really 150 different data parameters, from engine status, temperature, speed, location, fuel, and all this data, you can then be able to normalize it across the OEMs and then anonymize it. So, like, people, they don't have to feel worried about the fact that they're sharing their personal data. And then it's clean and enriched through AI machine learning. It's not something that's very easy to do. Like their engine is something that is actually quite hard for most OEMs to replicate, just because they don't have expertise within data management. So collecting data and collecting all those parameters has been quite a bottleneck for them. And the data is used for hundreds of possible use cases. So you can look at, finding parking to helping rental companies monitor their fleets. So like right now, you look at different rental companies like Avis Budget Group, they're an Otonomo customer. And right now, like they have these little dongles that you can, use in your cars, but then it's difficult for them to keep track of all of them, as well as the fact that with connected cars, 95 cars rolling off the factory floor these days are connected. So why not just use the systems built within the cars themselves to be able to track a much wider range of data from there? You can also look at usage-based insurance. That's a big one. You look at Metromile, like that's a usage-based vehicle insurance company, and they're using the same thing. They're using these dongles, and like they're actually called like telematics dongles. So Otonomo can potentially help replace it with the stuff that's already coming in the car. So in terms of competitive landscape here, Otonomo really leads by the fact that they have the most OEM partnerships. So like they have 16. Their nearest competitor has only like 3. So I think their nearest competitors are like, you can look at 𝐒𝐻𝐤, you can look at SmartCar. 𝐒𝐻𝐤 actually announced on Friday that they're also coming public via SPAC. It's actually coming public at a $2 billion valuation as opposed to Otonomo's $1.4 billion valuation. And the reason behind that is because they have actually some revenue to show for it. So definitely like not as much. And I still see like only like around like 10 to 20 million, I think. And Otonomo, like right now, they're still the leader because of the fact they have the most OEM partnerships. Their OEM partnerships comprise around 80% of the vehicles on the market. And they project a TAM of over 70 billion by 2030. And that's really going to be coming from increasing the amount of use cases per customer and increasing the number of cars that are being covered per customer. So just to size the opportunity, McKinsey, you can actually look at the study that they did on monetizing connected car data. And in their study, they concluded that the opportunity was around 450 to 750 billion by 2030. Now, of course, all of that won't go to Otonomo. So Otonomo's addressable market will be 70 billion by 2030. So even if they capture, like 1% of that, then it's going to be, a huge opportunity for them. So in terms of their main revenue lines, like right now, they make all their money from the marketplace. And that's just coming from the fact that, you look at all these OEMs, they're working with them. And then each time, like sort of a customer uses the data that Otonomo is able to collect, then, like Otonomo charges usage-based fees depending on the amount of data that they use. But they also are looking to have a SaaS offering, and 50% of their revenues will be coming from SaaS by 2025. The SaaS offering mainly involves, IoT Hub, Data Blur Engine. That's just stuff that, like the OEMs are able to use, or like the customers are able to use to, actually refine their own data and like be able to gather insights and analyze it better. So in terms of their financials, again, they're pretty aggressive, but they're targeting 60% gross margins for 2025. By 2021, it's still negative gross margins. The main reason behind that is because, like they actually need to get the data. But I think that once, once they actually get the data and they're able to scale, then it's going to be declining because the same data is going to be used for more and more use cases per customer between more and more customers. So it's really sort of a very like a very scalable model once they're able to get to a certain size. They're targeting to be EBITDA positive by 2024. So right now they're only trading at like just over 2 times 2025 revenue. And yeah, like this is just an illustrative case that shows that they can increase, their revenues right now by over 68 times for that customer, 11 times. So like it's either way, it's going to be huge just because of the fact that they're going to be able, like right now, they have around 140 commercial agreements. So 140 customers are already using their data. Most of those customers aren't paying for it, like they're just like using like for like 5 or 10% of their fleet. So the risk here is that like the customers, they don't see like the potential use case out of it, so like they're not going to pay for it. But I think like it's actually very significant value add for the reasons I mentioned. So I don't see like why they wouldn't pay for it when they deem it like very positive ROI. So yeah, like I think that once they're able to scale from like 5 to 10% of their fleet to like 100%, 80% of their fleet, and you're using more and more use cases per car, then it's really going to help their revenue grow very fast. So in terms of their moat, their primary moat is the cross-site network effects, and this is really coming from the fact that they have a marketplace, right? So like I'm not sure if you guys are familiar with GoodRx, but for GoodRx, they're a marketplace too. They basically help customers to save money on prescriptions. And the reason what like how they do that is they work with PBMs who offer their PBM rates to GoodRx that they're then able to pass along to their customers. So more PBM partners leads to more and more pricing data, which leads to a higher chance of GoodRx finding the cheapest drug costs out there. And that attracts more and more users, which then makes GoodRx a more and more important channel for the PBMs. And the same thing here is like really the fact that Otonomo has a lead in terms of OEM partners is really important, because customers, they don't want to work with like a dozen different OEMs. They don't want to work with GM. They don't want to work with GM, Ford, like all these different people, and then have to aggregate and then standardize the data themselves. They don't have time for that, and it costs a lot of money too. So the more data that Otonomo is able to aggregate, the more bargaining power they're going to have over the OEMs, because more customers leads to like OEMs viewing Otonomo as a more and more important revenue channel. And because the supply side is so fragmented, so because there's so many different OEMs, any single OEM won't be able to offer as much as the marketplace. So like you look at Ford, like they could be able to have like their own selling data directly to customers, but they won't be able to match up the same offering as a GM or like Daimler, BMW, all working together. For like some use cases, you need aggregated data. So like you look at smart cities, you look at traffic management. So like perhaps you can look at the traffic lights, sort of knowing when to change depending on the number of cars at an intersection. Now you really need to have data from as many OEMs as possible in order to make that work. And that's something that Otonomo is able to provide. So again, like the power of the marketplace is that they're able to standardize data across all the car models and all the OEMs. Like customers, they don't want to do that themselves. It's also important to note that the OEMs, they still get control of the data. They get to determine which services access data. They get to determine like who they sell to. So Otonomo's main value proposition is being able to aggregate and standardize that data, again, such that any OEM isn't able to match it alone. And you look at some of the use cases here. I talked about some already. Some of the more developed ones right now are usage-based insurance, being able to monitor rental fleets. So they already work with more and more fleets every single day. A big customer is 𝐒𝐴𝐵 Budget Group. Again, they are not only a customer, but they've also been a pretty big investor. So like there's still the risk of the fact that the market is so nascent right now, that really customers they might not be able to find the appropriate use cases. But so far that hasn't been the case. So far Otonomo has had customers coming to them knowing what they want. So I think that they right now they're quite sticky with the OEMs because they have their trust, right? So if you look at their competitors like Weizhou or like someone else, they only have 3 OEM partners. Now Otonomo has 16. And that has been the hard part. Like on a recent podcast, the CEO said that was like the hard part. It's getting their trust. And that took 3 years. Now they have their trust, and the customers are coming to them knowing what they want. And Otonomo is able to be there to provide it for them. In fact, like the relationships with the OEM run so deep that the OEM sometimes use Otonomo as their own data enablement department. So the fact that I think Otonomo has partnered up with all of the major OEMs already, covering 80% of the vehicle market, is quite telling. It's really showing their sort of like the actual willingness of the OEMs to want to monetize their data. So as I mentioned in the beginning, the primary risk here is a competitor that is able to develop a single car OS. And BlackBerry right now, they're actually the ones who have the biggest ambitions to do that. Big tech has tried in the past, but I think the problem with big tech is the fact that they the OEMs, they don't really view big tech as partners, as potential threats, because big tech wants to penetrate into the in-car experience. And OEMs, they don't want that. Like they don't want to see potentially the most valuable part of their cars to big tech and give them all the data. But BlackBerry is a neutral third party. So they allow OEMs keep all their data within the car itself. And with BlackBerry Ivy, which is their new, data platform, they're able to implement it on top of the cars that are originally on the QNX operating system, which is already in 175 million cars on the road. Ivy potentially helps aggregate all the sensor data within cars that are running on QNX and then normalize it. So developers can just go directly to the OEMs and get normalized data. Now, I think, the issue is that Otonomo will be disintermediary in that case. Like you don't need a marketplace, you don't need to pay those additional fees. You can just go directly to the OEMs. But I think sort of the caveat here is, first of all, Ivy is still far away. It's going to be in the 2023 models to start. It's also like BlackBerry, like they haven't been the greatest at executing in the past. So they actually have, like right now, I think they have lower cash balance than Otonomo. Like Otonomo right now, they have like almost 350, almost 400 million in the bank after their SPAC deal. So they are definitely very, very well capitalized to be able to pursue this opportunity. And that's something, that like building a single car OS, that's something that will be quite a challenge for BlackBerry to do.
Okay, that was the last slide. Did I get that right?
Yeah. So like overall, like I really view this as like a good risk reward, especially from these levels. Like it's only around like 6% above their net asset value of $10. So you have that $10 SPAC floor in place, and there's been really heavy insider buying in the past couple of weeks. Like you look at like if you look at it, there's this actually this Saudi fund that has been buying like they own like over 20% of the float right now. So that's crazy. Like I don't know like what like if they know something, but it's just just been crazy buying from them.
Great, thank you so much. That was an awesome presentation. We're gonna let me turn it over to Rob, my co-host here, see if he has any questions, and then Richard,
and like one last thing is I personally don't own common shares. Like I own I think it was like a 5% position of my portfolio in warrants. So the warrants basically convert to one common share each at $11 and 50 cents, and they expire by 2027. Now the reason why I did that is because the warrants, they are actually like they crashed significantly the past couple of weeks. And I think that they're pretty cheap here. I think there's not a lot of downside left just because of the implied volatility. And I think that they're, like a pretty good bet if you're bullish on them. But like the fact with warrants is that they can go to zero if the merger falls apart. So that's something that you need to be aware of. So it's much more risky than common shares because you don't have the $10 floor, but it has more upside. My fund, Luca, owns a position, like a 2% position in the common shares.
Thank you. I appreciate that disclosure. If you guys have any questions, please raise your hand. This is a unique and rare opportunity to ask questions directly from Richard Chu. So while we wait for you to raise your hands or put a question in chat, Rob, let me turn it over to you, see if you have any questions for Richard.
Yeah, this is a really interesting company. Thanks for bringing it to our attention. I actually work in the microprocessor field, and I've heard about electric vehicles and vehicles needing tons of data collection. So I'm familiar with it. How does the transition from like gas vehicles to electric vehicles affect Otonomo? Do they have fleets of like electric vehicles they're working with?
So actually, like right now, they don't have any electric vehicle partners. I think that they are actively looking to get there. They actually have an EV specific module, which allows OEMs or customers to be able to track the specific battery level of their cars. So that again could be something that's really useful for fleet management. And if EV companies want to monetize their data, which I don't see like why they wouldn't, then they would need to come to Otonomo's marketplace, because Otonomo has access to the ability to standardize the data across all of the different OEMs. So it's going to be much higher value proposition than going it alone.
Got it. And as more cars switch over to electric vehicles in the next 20, 30 years, does BlackBerry have any advantages over Otonomo?
Yeah, so like I think BlackBerry's primary advantage like right now is just the fact that they have like a neutral position. So they're working with they're working with AWS right now to be able to monetize or like really be able to leverage their cloud and sort of machine learning capabilities in order to really help customers make sense of that data that they're collecting from the OS. So like that sort of neutral sort of positioning is something that they have as an OS that big tech wouldn't necessarily have.
Got it.
Okay, looks like a couple questions came in on in chat. I got Sanjay asking about those competitors he had mentioned. I think this chart is the one he wanted. Yeah, if you could quickly review this one more time for Sanjay.
Yeah, so I think like the main competitors are 𝐂𝐤o and SmartCar. So 𝐂𝐤o is actually, they're like as I mentioned, they're going public by SPAC. Like very soon. They're based in the UK. They have like around 3 partners, but mainly their advantage is the fact that they have a very deep partnership with GM. So GM signed like actually like a big agreement with them, and GM is also an investor, but GM is also, I think, Otonomo customer as well, just because like they obviously want to sort of monetize their data as much as possible, and Otonomo has the most data right now. So yeah, like with SmartCar, they're kind of different because like they are based in the US and they're actually funded by A16Z, which is another, like I'm sure you're all familiar with, a very, very top tier VC firm. And with SmartCar, like basically like they, instead of like having for like the whole marketplace model, like they really allow developers to access sort of specific functionality via API alone. So like in terms of like if you're working at SmartCar, then you have this app where you get like you give permission for SmartCar to be able to use the data from the car. So it's kind of different from the Otonomo model.
Okay, we got another question. Thank you for that, Richard. From John Sisson, what is the current cash burn rate?
Yeah, so like I think in terms of like 2020, it was around like 10 yeah, like they had like sort of negative 11 million in terms of their EBITDA. So like in terms of like this year, like I think they're going to go through like 20 million. So it's not very high in comparison to you know, like their cash balance right now is like around 375, which is enough to fund their next 5-year plan to really get there. Yeah, like I think they mentioned at the start when they SPAC that their current cash will be more than enough to fund their 5-year plan.
And we have a question from Sanjay on telehealth. A question on digital health. Looking long term, how do you see the telehealth and remote health marketing evolving? Ultimately, won't the insurance companies, employers, patients, doctors prefer to deal with a single telehealth provider that supports multiple devices for different chronic conditions?
Yeah, like I think like see the telehealth and remote health market evolving. Yeah, like I think that's sort of the main argument with Teladoc is the fact that, you know, like you look at sort of like all the telehealth vendors out there, and they sort of like are all offering sort of similar like very similar value props. And the fact is that, you know, providers, employers, they don't want to work with like 30 different companies just to get their sort of conditions covered. And with Teladoc is the fact that not only they have telehealth, I mean that telemedicine, they also have remote patient monitoring, all within the same interface. Like that sort of really simplifies things for health systems. That really simplifies things for employers as well. And yeah, it's a big to be like a one-stop shop. I think is a very good position for them. And in terms of like this being like winner take all market, like I don't think it's necessarily like going to be a winner take all. It's more so going to be like a winner take most, I think. Right now, Teladoc is covered by 50% of the Fortune 500, like almost 50% of the Fortune 500 employers. So like they clearly own the employer space. There's other companies like Amwell that own sort of the health system space. But I think that employers, payers are really sort of the place where you want to be in the long term, is because like these health plans, employers, like they are able to determine where the spend goes. And I think really sort of they have the most long-term incentives to be able to make the investment in a service like Teladoc, because like they really care about, you know, like employee costs and like employee health over the next 5 years, something that sort of health systems under a fee for service won't necessarily care about to the same extent.
I have a follow-up to that before we get to the next question. So in that case, like how do you allocate a Teladoc versus some of the smaller names? I guess there's more risk, for example, in a Dario Health. So even if you're looking at the revenue multiples and it looks cheap, or even if, let's say at the moment it would be cheaper than Teladoc, but given that that Teladoc's going to have, how do you account for that? I don't know if you have a position in Dario now, but just as an example in terms of portfolio allocation, how do you look at that?
Yeah, so like Dario is like right now, I think around the 4% position for me. Mainly it's the fact that if they do execute, then they have a lot more upside. But like I like remote patient monitoring companies a lot better than telemedicine companies. Like I would never invest in like a pure play, small kind of telemedicine company. Like there's been some new SPACs coming out. And like they're just focused on, you know, like telemedicine alone, which I think is very, very hard to differentiate yourself in. Like telemedicine, by large, you're operating based on scale. Like you're trying to aggregate as many providers as possible, and then be able to, you know, like actually then be able to reduce your patient wait times and such. But with remote patient monitoring, there are much higher barriers to entry. Like with Dario, they need to actually get proven results, proven studies. Dario's 14,000 customer reviews. Like that's something that is all competitive advantages for them. That someone that's starting new in the remote patient monitoring space will need a very, very long time to actually accumulate.
Interesting. Okay, we got a couple other questions. By the way, if anyone wants to come on audio, just raise your hand. Makes it a little more interesting. But Rob, you want to read out these next two for us?
Yeah, we have one from Tom W. Are you worried about sentiment of the SPAC market currently? There seems to be less enthusiasm as more SPACs are trading closer to net asset value.
Yeah, so I think with SPACs specifically, you need to pick them. Like there's definitely like a lot of really bad SPACs that are coming out. And really like there are definitely some gems in there as well. So yeah, like the risk before the merger is always locked by the $10 floor, but like of course anything can happen afterwards, right? Like you look at Clover, like what happened to Clover? It's like trading at $7 now. So really, like I think you need to be careful about which companies you're investing into. You still need to manage risk, but at the same time, I don't think that people should necessarily dismiss SPAC as the entire sector just because of the fact that like a lot of them may not necessarily be very high quality.
Got it. And then another question from Florian. How do you think about position size and when do you average up or down?
So like in terms of like position size, like I think really I want to see a company start to execute. Really depends on valuation as well. So for a company like Dario, like I think at $12, they were definitely very, very attractive in terms of like there was a significant margin of safety in terms of like if they are able to, like do at least sort of like a fraction of what they're saying, then it's still going to turn out to be an amazing investment. And like now trading at like around like $23, I think that they really need to like actually have like good guidance on Tuesday, like 40% growth I'm expecting at least. So yeah, there's definitely that. But at the same time, they've actually demonstrated that they've got like they've been executing really well. So I've been actually adding over the past couple of months. And like the main reason behind that is because they've shown that they can actually get those Fortune 500 contracts, and they're able to actually make moves like the acquisition of Upright, which was like actually for a really great price.
Makes sense. Thank you.
Yeah, we have a bunch of other questions. Rich, do you have time for a few more?
Yeah. So like just in terms of the next one from Sanjay, in terms of like GoodRx, I'm not really worried about Amazon, mainly because of the fact that Amazon is in like a lot of people's space, and like it hasn't been something that like really has been killing has killed these companies. Of course, it really depends on the case, but like most of the times, like Amazon entering an industry, it's a buying opportunity more often than not. Specifically here, like I think the main trouble that Amazon will face is the fact that PBMs, pharmacies, like they're not going to want to work with Amazon because Amazon, they're focused on attracting customers to their mail order pharmacy. GoodRx, they don't do like mail order pharmacy. Mail order pharmacy is like 5% of the total prescriptions out there. So even though it could be like something big in the future, like right now, it's not gonna like I don't see it significantly affecting GoodRx in the near term. Are you familiar with BTCY or NMRD? So I've looked into NMRD a bit. Ben actually introduced me to the company a while ago, and yeah, like I think it has a lot of potential. Like they definitely seem like they have like a pretty solid product, but it's like this is pre-revenue. I think I want to see like more evidence of them actually being able to execute and like on their go-to-market strategy. Like I think the big risk here is actually the difficulty of getting your first few customers in the space. Like once you have like sort of those customers down, then it's pretty easy to sort of scale up from there. And like that's what Livongo had. Like Livongo's product isn't necessarily the best on the market, but because they had like I think like 30% of Fortune 500, people associate sort of digital therapeutic space like remote patient monitoring with Livongo, and they were sort of really benefiting from that first mover advantage.
All right, cool. I have one last question to close it out. Actually, I'm going to point this out first. Twitter is Richard_Chu97. I don't know if you're actively promoting your Substack, but I saw it on your Twitter, so I threw it up there. But what I wanted to ask you about is on your Twitter here, you post, let me get here. Here it is. On your Twitter, you'll once in a while post these charts right here. And I was very interested if you could give us a couple minutes. This looks like something proprietary to yourself, right? And it looks very interesting. Looks like you put a ton of work into this, whatever it is. So if you can walk us through what this is, that'll be awesome.
Yeah, so it's just like a valuation scatter plot, and I think it helps to chart out relative valuation. Like, of course, like when you're like valuing a company, the multiple is just like one thing that you look at. You also like there's tons of other factors, and those companies that are really above that line of best fit that you see running across, it doesn't necessarily mean they're overvalued. Like typically those companies like CrowdStrike, C3 AI, like they're all like the top tier companies, and I think they really deserve their valuation in some cases. And like same thing with the companies that are below. Like you see like some like lots of like lower tier companies there that may not that that might be sort of they probably deserve their low multiples on purpose. So really what this chart is showing is that like sometimes you can find, sort of like a high level view of which companies are relatively undervalued or relatively overvalued. And the line across the bottom, like on the x-axis, you see, like their next 3-year revenue CAGR. And on the y-axis, you see the price divided by 2021 gross profit. So really, like I think you want to be looking at the companies to the bottom right. And those are companies with high growth. They're trading at low multiples. Most of the times, those companies turn out to be really good bets. So Livongo was there before. Dario was there before. You look at Skills. You look at Weedmaps, SSBK. And those companies have been some of the top performers this year. OptimizeRx, someone is also saying it's well placed. And OptimizeRx is a company that I've been looking into. It's very interesting, actually. So like it's like a platform for patient messaging. So basically, like they work with they're integrated with all the EHRs, and they provide like a way for pharma companies to market directly to doctors, to physicians, their new sort of drugs. And it's like during COVID, they've been especially benefiting because pharma companies, they can't fly their sales reps to really see doctors anymore. And they're really starting to use OptimizeRx, and they're finding that it can be like a much more efficient way than traditional sales reps.
That's helpful. It looks like there's a lot of work that goes behind this because, for example, where do you get some of this data? You're talking about 2023 revenue. Are you estimating this yourself, or are you getting this from analyst reports? How do you populate this data?
Yeah, so like the data is mostly from FactSet in terms of like the revenue CAGR, like the consensus estimates for the next few years. That's from FactSet. The other data, like like the stock quotes and stuff, that's actually pulled from Excel. Like Excel has a built-in API that can pull real-time stock quotes for you. You just have to refresh it. You just like it should be like under the data tab if you can play around with it. But like everything else, it's just built using like just plain Excel, and Excel.
So these are
like,
basically analyst estimates. You're not making your own estimates of, for example, what Dario's revenue would be in 2023.
Yeah, like I have my own estimates, but like I think like to just keep it even for like all these companies, because I'm not familiar enough with all these companies to make my own.
Got it.
And
cool.
Yeah,
that is a very nice, fascinating process. So anything else you want to add? Any website or anything you want to direct people to?
Yeah, so like one last guy is like yeah, like I don't have any research right now like on OptimizeRx, but like after I look into it more in depth, I will maybe post something on Twitter. So yeah, people can follow me on Twitter, and like on my Substack, I have write-ups on GridRx, write-ups on like Teledoc as well, and on my Twitter sometimes like I post threads on Dario, and I like posted one on Otonomo as well. So you can follow me there.
Cool. Awesome. Thank you so much, Richard. For our VIP members, we opened an SAII research group tonight. You can collaborate on WhatsApp among yourselves over there. I want to let you know about future upcoming events. Again, just click the performance link there at storytrading.com. We have Mark Gomes this Wednesday on asset allocation and portfolio management strategies. And Ashley Day and Polo Gonzalez, we're so excited for that. It's going to be his first VIP presentation. He's a great stock picker, so I'm real excited. He's going to come public this time next Sunday to give us his ideas on that. So looking forward to that. Thank you, everyone. We're going to wrap up the recording here, and we're going to move on to Trade of the Week. Thank you.